Today, we're going to look at real estate in a pretty wild way. Not priced in dollars, but priced in silver. Yeah, you heard that right. It's a historical yardstick that might just change how you think about value altogether.
So let's just jump right in with this mind-bending question. Could you really trade one single house for 23? It sounds kind of like financial alchemy, right? But it's actually the result of a fascinating thought experiment we're going to break down.
And look, this idea isn't just pulled out of thin air. The whole framework comes from an analysis in Mike Maloney's book, Guide to Investing in Gold and Silver. We're basically going to walk through his logic and see how he uses history to build this pretty powerful scenario.
Okay, so let's get into it. The core concept here is something the book calls the silver yardstick. And the idea is actually super simple. Just for a minute, forget about dollars. What if we measured the price of a house in ounces of silver?
And the tool that makes this all work is the silver to housing ratio. The math couldn't be easier. You just take the median U.S. home price and you divide it by whatever the price of 1 ounce of silver is. The answer you get? That's the price of a house quoted in pure silver.
Now, what's really key to understand here is that this isn't about, dragging wheelbarrows full of silver to a closing. It's an accounting tool. You're still using dollars, but they're just the go-between to see the true relative value between two completely different things, a house and a hunk of metal.
And this is where the theory gets really interesting. Let's look at the dramatic historical example from the book that just brings this whole idea to life. So we're going to rewind the clock and head back to the 1970s. So the analysis really zeroes in on the precious metals bull market back in the 70s. You see, at the beginning of the decade, a median home was priced at what was basically a mountain of silver. But by the end of it, whoa, that valuation had been turned completely upside down.
Check out these numbers from the analysis. In 1971, the price of a median home was 14,823 ounces of silver. Just try to picture that for a second. That's almost 1,000 pounds of actual metal.
Okay, now watch this. By January of 1980, not even a decade later, that number had absolutely cratered to just 814 ounces. The house became more than 94% cheaper when you priced it in silver. And the craziest part, during that same period, its dollar price had actually doubled. And that massive swing in the ratio is what fuels the book's really mind-blowing hypothetical. It basically suggests that if you had sold one house in '71, put all that cash into silver, and then turned it all back into dollars in 1980, you could have bought 18 similar houses. Outright, free and clear.
So this gets to the heart of the whole analysis. This idea that these valuations move in these huge, decades-long cycles. And if that's the case, well, then you can use the past as a kind of lens to imagine what could possibly happen in the future.
And believe me, the cycle definitely did not end in 1980. The ratio swung wildly in the other direction, hitting an insane all-time high in 2002. At that peak, it took over 38,000 ounces of silver to buy a home. That made real estate more than twice as expensive, in silver terms, as it was way back in 1971.
Now, based on those historical roller coaster rides, the author kind of speculates that the cycle could repeat itself. He throws out a future scenario where the ratio could fall even lower, to less than 500 ounces per home. And let's be super clear, this is framed as a thought experiment about what's possible, not some guarantee of what's certain to happen.
And this is exactly how we tie it all together and get back to that crazy question about 23 homes. The arithmetic is pretty straightforward. You sell a house today, you convert all that cash into silver. You wait for the ratio to hit some hypothetical low, and then you convert it all back. Theoretically, your purchasing power could be magnified that much.
Okay, pause. This is a really crucial pivot point. Before anyone gets any grand ideas, it is time for a major reality check. Because the journey from a clean, perfect thought experiment to the messy, complicated real world, well, it's full of roadblocks. This slide just lays out the difference perfectly. On one hand, you have the hypothetical, which exists in this frictionless fantasy land. No taxes, no fees, and this magical ability to time the market perfectly. Reality, of course, is the total opposite. It's messy, it's full of costs, tons of risk, and the fact that you don't own a national average house, you own one specific house on one specific street.
And let's get specific about those real-world problems, which, to be fair, the analysis itself is careful to point out. You've got a huge capital gains tax bill staring you in the face. Then there's the 6% realtor commission, the gap between what you buy silver for and what you sell it for. You even have to pay to store and insure all that metal. And the timing risk? It's astronomical. That January 1980 peak lasted for the blink of an eye. Hitting that exact window isn't about skill,
It's about sheer dumb luck.
So after putting this whole idea through the ringer, what's the actual takeaway here? What's the real value of looking at the world this way?
The true power of this ratio isn't as some secret trading strategy. It's a relative value lens. It's like putting on a new pair of glasses that filters out all the noise of day-to-day dollar prices and shows you the raw dramatic swings in how the market values one tangible asset against another over really long periods of time. And this is probably the most important thing to remember. While it's a powerful lens for looking at the past, it is absolutely not a map to the future. The analysis itself stresses this point. History might rhyme, but cherry-picking the absolute best and worst days of a past cycle is no guarantee you can ever repeat that trick.
So all of this really leaves us with a much bigger, more fundamental question. If dollars can sometimes be a shaky measuring stick, and other yardsticks like silver have their own issues, then what is the truest way to measure the value of anything? That's a fascinating question to chew on.